Let's talk numbers right out of the gate. Keel Infrastructure Corp., trading under the ticker KEAL on the NASDAQ, is changing hands around $3.28 per share, giving the market capitalization a baseline hovering near $2.17 billion. On paper, to the average retail scroll swiper opening up Robinhood or TradingView during their morning commute, Keel looks like a classic high-beta, early-stage play bleeding red ink. With a trailing revenue footprint sitting around $229 million and a negative net income profile posting deep losses, standard financial media and consensus screeners write it off as another speculative cash burner. They look at the normalized PE multiples sitting deep in negative territory and assume it's just a volatile mid-cap artifact of market noise. But standard financial media is entirely missing the forest for the trees. They are analyzing Keel through the rearview mirror, treating it like a standard legacy operator, completely blind to the macro-structural physics bottleneck that defines modern computing infrastructure. The dirty little secret of the artificial intelligence and high-performance computing boom is not just about silicon architecture or advanced packaging. It is about power and electrons. Hyperscalers and mega-cap tech giants have billions of dollars burning a hole in their balance sheets, desperate to scale cluster sizes for frontier model training and inference. Yet they are slamming headfirst into a brutal grid reality: power scarcity. You cannot plug a gigawatt-scale AI data center into a legacy suburban substation. Traditional electrical grids are maxed out, permitting pipelines take years, and the structural lag in electrical infrastructure has created the ultimate bottleneck of the decade. This is precisely where Keel Infrastructure Corp. Enters the equation, executing one of the most brilliant strategic pivots in corporate history. Formerly known to the market as Bitfarms, a legacy crypto mining operation that retail investors pigeonholed into cyclical digital asset volatility, the company underwent a profound metamorphosis, rebranding explicitly into Keel Infrastructure Corp. This wasn't just a cosmetic name change, it was a foundational structural reallocation of assets. While retail traders were busy getting shaken out by crypto dips, management was quietly sitting on a gold mine: multi-gigawatt power pipelines and prime secured grid interconnects located across high-demand power markets like Pennsylvania, Washington, and Quebec. They owned the real estate, they owned the direct grid interconnects, and most importantly, they owned the megawatts. While the broader retail crowd scrolls through social media feeds complaining about quarterly earnings misses and short-term volatility, institutional heavyweights are looking at a completely different metric: interconnected power capacity per share. The market is currently pricing Keel as a speculative asset, entirely blind to the fact that owning brownfield and greenfield sites with pre-approved power capacity in constrained grid regions is the single most valuable corporate real estate play of the AI era. You can spin up software overnight, and you can fab chips in a few months, but you cannot magic a gigawatt of grid power into existence. That takes years of regulatory clearance, substation engineering, and capital placement, assets that Keel already holds in its vault. When you look under the hood of Keel's daily trading volume, you witness a masterclass in institutional accumulation masked by retail frustration. With a beta coefficient sitting high at 3.78, Keel acts as a hypersensitive liquidity sponge. On any given macro jitter, whether it's a hotter-than-expected inflation print, a sudden spike in treasury yields, or broader tech sector rotation, Keel experiences outsized intraday swings. This high volatility is a deliberate weapon used by smart money. Institutional desks and sophisticated market makers exploit the emotional fragility of retail investors who piled into the stock during headline-chasing rallies. When retail traders see a negative quarterly earnings surprise, such as the recent print showing a wider-than-expected loss per share, they panic sell. Automated stop losses trigger, social media sentiment turns toxic, and retail volume dries up. This is precisely when institutional accumulation phase begins. While the public screams about cash burn and negative return on equity, quiet block trades are executed at structural support levels. Smart money looks past the near-term operational losses because they understand the capital expenditure roadmap. They know that converting legacy high-density power sites into enterprise-grade AI and HPC data centers requires upfront capital investment, which naturally depresses short-term margins. The institutional thesis rests entirely on asset transformation economics. Major funds are locking in shares because they recognize that Keel's enterprise value relative to its total secured power pipeline is an asymmetric value gap. They're not buying the trailing 12 months of revenue, they're buying a call option on scarce megawatts in a power-starved North American grid. Every time weak hands get shaken out during a routine pullback, institutional accumulation tightens the float, setting the stage for sharp, explosive upward re-ratings whenever a major hyperscale partnership, power purchase agreement, or infrastructure monetization deal drops over the wire. Before we break down the operational mechanics of how these energy assets translate into high-margin enterprise data center leases, let's pause for a second. Where do you stand on this accumulation phase? Are you scaling into Keel during these volatile pullbacks while the broader market looks the other way? Or are you sitting on the sidelines waiting for a confirmed breakout above resistance? Let me know your strategy down below. To truly grasp why KEEL Infrastructure Corp is positioned for a dramatic revaluation, you have to strip away the outdated historical framing that haunts the company. For years, the market viewed this entity strictly through a single-lens paradigm, a volatile digital asset miner subject to the whims of network difficulty, halving cycles, and the price action of underlying tokens. In that old paradigm, capital expenditure was expended exclusively on specialized compute rigs, and revenues fluctuated wildly with energy spot prices and crypto sentiment. Management looked at that cyclical trap and engineered a strategic pivot that rewrote the company's DNA. They realized that the physical infrastructure underpinning digital asset mining, massive electrical substations, robust cooling distribution networks, high-capacity transformer yards, and direct, low-cost power purchase agreements is functionally identical to the infrastructure required for modern artificial intelligence and high-performance computing. Instead of fighting the crypto cycle, they leveraged their existing footprint to launch a dual-engine or complete structural transition into a premier digital infrastructure and energy provider. Today, KEEL Infrastructure Corp develops, owns, and operates data centers and dedicated energy assets across strategic North American jurisdictions, including its core campuses in Moses Lake, Panther Creek, Sharon, Sherbrooke, and Scrubgrass. This portfolio is not just a collection of random warehouses, it is a meticulously engineered network of power-dense real estate boasting a massive development pipeline totaling over 2.2 gigawatts. To put that scale into perspective for retail investors who might not understand utility math, a single gigawatt is enough power to light up hundreds of thousands of homes. In the context of AI data centers, securing multi-hundred megawatt blocks with pre-established grid interconnects turns KEEL from a commodity operator into a supreme infrastructure gatekeeper. The operational model has fundamentally shifted. Instead of taking direct balance sheet exposure to digital assets, the core business model is evolving towards recurring, long-term, high-margin co-location and infrastructure leasing agreements with hyperscalers, cloud service providers, and enterprise AI developers. These clients demand continuous, uninterrupted power uptime, massive thermal dissipation capacity, and secure physical footprints, all of which KEEL's facilities are uniquely engineered to provide. By repurposing brownfield energy assets, such as former industrial or power generation sites equipped with legacy transmission lines, KEEL bypasses the multi-year bureaucratic nightmare of greenfield grid connection queues. While a brand new data center developer has to wait 5 to 7 years just to get a utility interconnection study approved by regional transmission organizations, Keel already has the grid access wired and ready to deploy. This time-to-market advantage is the ultimate economic moat in the current tech landscape. As we look across the multi-year horizon, the catalysts lining up for Keel Infrastructure Corp are deeply intertwined with the broader capital expenditure supercycle of mega-cap tech spenders. Hyperscale cloud giants are pouring hundreds of billions of dollars into data center expansion, but they are increasingly hitting a brick wall of municipal zoning restrictions and power availability. Because Tier 1 markets like Northern Virginia's Data Center Alley are experiencing severe power caps and soaring land costs, enterprise capital is aggressively migrating to secondary and tertiary power-rich markets where Keel holds strategic dominance. The primary multi-year catalyst for Keel is the conversion and commercialization of its 2.2 gigawatt pipeline. As individual campuses such as Panther Creek, Sharon, or Moses Lake complete their infrastructure upgrades and sign multi-year lease agreements with credit-worthy tech tenants, the financial profile of the company